Sometime in early 2026, an internal memo circulated within Amazon. It detailed a plan to eliminate 16 software development engineer roles in Seattle. The cuts seemed minor compared to the 30,000 layoffs already completed, but they highlighted a quiet structural transformation inside the tech giant. Amazon is shedding its senior engineering talent to fund a different kind of war. For over a decade, Amazon Web Services was the undisputed cloud king. It pioneered the market, hosting the world's most popular digital services. The high margins of AWS funded Amazon's global retail operations, but today that financial engine is facing a quiet crisis. In the generative artificial intelligence era, Amazon is losing its momentum. While it remains the largest cloud provider, it is growing the slowest. Competitors are eroding its pricing power and capturing key workloads. To fight back, Amazon is executing an expensive defensive strategy. They are committing a staggering $200 billion to capital expenditures. To fund this build-out, Amazon has turned to the debt market. The company has raised over $100 billion in 12 months. This heavy borrowing campaign has left its free cash flow in ruins. In 2024, Amazon reported $32.9 billion in free cash flow. By 2025, that figure fell to $7.7 billion. By mid-2026, it plummeted to just $1.2 billion. Amazon is now reinvesting over 90% of its operating cash into infrastructure. This capital intensity far exceeds the spending of Microsoft and Google. In March of 2026, Amazon launched a $37 billion bond sale. A European offering raised nearly $17 billion shortly after. A Canadian bond sale brought in another $10 billion. In July of 2026, they launched another heavy $25 billion sale. This brought their total 12-month borrowing to $107 billion. The architect of this spend-at-all-cost strategy is Chief Executive Officer Andy Jassy. Jassy has publicly defended the massive scale of the infrastructure budget. He stated that artificial intelligence is a once-in-a-lifetime opportunity. He declared that Amazon would not be conservative in how they play this, but Wall Street is not entirely convinced by Jassy's optimism. During an earnings call, Morgan Stanley analyst Brian Nowak challenged the CEO. Now, we questioned Jassy on the narrative that AWS is falling behind. The financial data from the past year suggests the analyst was right. AWS saw its global cloud market share drop to 28%. In contrast, Microsoft Azure has captured 21% of the market. Google Cloud has grown its share to 14%. It is not just about raw market share, but about growth rates. AWS grew its quarterly revenue by 28%, but Azure grew by 40% during the same period. Google Cloud outpaced them both, growing by 63%. Google is leveraging its custom TPU chips and Vertex AI platform. This has allowed Google to win over highly valuable AI-native startups. Microsoft has integrated its Copilot tools across its enterprise software. Meanwhile, AWS is struggling with its custom chip strategy. Amazon heavily promotes its custom Trainium processors as a cheaper option. They claim Trainium offers a viable alternative to NVIDIA's expensive hardware, but the development of Trainium 3 has been plagued by delays. In July of 2025, audits revealed failures in the chip's cooling. Liquid cooling design issues forced AWS to postpone the release. They rushed to ship early volumes of the chip in May 2026, but the delay gave NVIDIA time to solidify its market dominance. More importantly, major artificial intelligence developers are rejecting Trainium. Startups complain that Trainium software development kits are less competitive. They cite critical software optimization issues as barriers to adoption. This friction was exposed during negotiations with OpenAI. In late 2025, OpenAI signed a $38 billion AWS deal, but internal details revealed that OpenAI rejected Amazon's custom silicon. OpenAI insisted on using only NVIDIA graphic processing units. This refusal highlighted the weakness of Amazon's chip strategy. Without a strong proprietary chip, Amazon must buy expensive NVIDIA hardware. This leaves Amazon's margins exposed to NVIDIA's pricing power. To solve its model deficit, Amazon turned to a third-party startup. They formed an alliance with Anthropic, the maker of Claude. Amazon's total investment commitment in Anthropic is $33 billion. They committed an initial $8 billion starting in late 2023. In April of 2026, they pledged another $25 billion. Today, Claude drives most of the traffic on Amazon's Bedrock portal. On paper, Amazon's stake in Anthropic is worth $74 billion. This valuation generated a $16.8 billion paper gain. That paper gain accounted for 40% of Amazon's pre-tax income, but relying on a single startup is a precarious foundation. On June 1st, 2026, Anthropic confidentially filed for an IPO. Anthropic has committed to spending $100 billion with AWS, but Anthropic also maintains a close relationship with Google. Anthropic CEO Dario Amodei has successfully leveraged both tech giants. He has extracted tens of billions in compute resources from both companies. Amodei stated that his users find Claude increasingly indispensable. He noted that Anthropic must build infrastructure to keep pace. This means Amazon must keep spending billions to support Anthropic's research. AWS CEO Matt Garman is tasked with managing this huge construction. Garman took over the cloud unit in 2024. He is overseeing a major restructuring of the engineering workforce. To offset infrastructure costs, Amazon has cut senior staff. They are replacing them with 11,000 early career software developers. But managing this transition has created friction within AWS. Former employees describe an increasingly bureaucratic culture. This bureaucracy has slowed down Amazon's internal AI development. Nowhere is this slowdown more visible than in the Alexa division. Alexa was once Amazon's flagship consumer hardware product. It sits inside more than 100 million smart home devices. But today, the voice assistant remains conversational deadwood. It is unable to complete basic, complex reasoning tasks. Consumers use it mostly to set timers and play music. Amazon's hardware division is led by Senior Vice President Panos Panay. Panay promised that a smarter web version of Alexa would launch soon. This project, internally called Project Metis, has faced severe setbacks. Internal documents show the web debut was delayed past July 2025. The upgraded version, called Alexa Plus, is trapped in development hell. Software bugs and performance issues have repeatedly delayed the release. While OpenAI and Google deploy advanced models, Alexa remains outdated. This leaves Amazon without a consumer-facing AI touchpoint. They must rely entirely on their enterprise cloud partnerships. But the economics of enterprise cloud AI are brutal. Hosting other companies' models requires vast amounts of power. Data center construction costs are rising due to supply shortages. Amazon's capital expenditures have grown by 53% in 1 year. They went from $131 billion to $200 billion. This spend represents nearly 28% of the entire industry's budget. Yet, AWS's revenue growth is not keeping pace with the spending. In the first quarter of 2026, AWS revenue was $37 billion. This represents an annualized run rate of $150 billion. While that number sounds large, the margins are shrinking. The cost of maintaining NVIDIA chips eats into the profitability. If Trainium cannot gain traction, AWS will remain dependent on NVIDIA. This dependency limits Amazon's ability to control its own costs. At the same time, Anthropic's upcoming IPO introduces new uncertainty. Once public, Anthropic may face pressure to diversify its cloud providers. Amazon's paper gains could quickly evaporate if Anthropic's stock struggles. This would expose the underlying weakness of Amazon's core earnings. 40% of their pre-tax income is built on valuation metrics. If you strip away the paper gains, the profit numbers look different. This explains why Amazon is desperately cutting corporate headcounts. The 30,000 layoffs were designed to protect the operating margin. Legally mandated filings show that these layoffs are still quietly continuing. Amazon is trading its human capital for data center steel. They are trading free cash flow for long-term corporate debt. This pivot is a dramatic departure from Amazon's historical model. Traditionally, Amazon built infrastructure after they had demand. Today, they are building infrastructure in the hope that demand arrives. They are building gigawatt-scale data centers for models not yet built. This strategy is driven by a fear of being left behind. Microsoft Azure's deep integration with OpenAI gave them an early lead. Google's decade of AI research gave them a technological advantage. Amazon is trying to bridge this gap with pure capital. But capital alone cannot fix software development kits that do not work. It cannot convince developers to leave the NVIDIA CUDA ecosystem, and it cannot fix the bugs paralyzing the Alexa division. The reality of the modern AI war is highly qualitative. It is a battle of software ecosystems, model architectures, and developers. In all three areas, Amazon is currently playing catch-up. They are hosting the revolution, but they are not leading it. When AWS was founded, it succeeded by offering cheap, flexible computing. Today, AI computing is incredibly expensive and highly rigid. This structural shift threatens the very foundation of the AWS model. If AWS becomes a low-margin utility, Amazon's retail business suffers. The global logistics network relies on AWS profits to operate. Without those profits, Amazon cannot fund its retail expansion. The entire corporate ecosystem is tied to the success of AWS. That is why Andy Jassy has no choice but to double down. He must keep borrowing, building, and cutting costs. He must hope that Trainium eventually becomes competitive. He must hope that Anthropic remains loyal after its IPO. And he must hope that corporate buyers choose Bedrock over Azure. If any of these assumptions fail, the financial consequences will be severe. Already, the debt mountain is growing while free cash flow disappears. The undisputed king of the cloud is now fighting on the defensive. They are spending more than ever just to stay in the race. But in the AI war, spending the most might still mean losing.